This week's key macro question is a W-shaped market in a U-shaped economy still our base case scenario? And our answer is no, it is not. Evidence continues to mount in support of our core fundamental thesis that the bond market broke President Trump and his administration's willingness to tolerate the significant pain required to facilitate a transition to paradigm B, most notably signaling that the trade negotiations with China are likely to occur within weeks, as well as continuing to celebrate positive economic data in what was originally labeled as Biden's economy. As we signaled a few weeks ago, the administration has clearly pivoted to promoting the pro-growth, pro-markets aspects of the Trump 2.0 agenda, essentially truncating the detox period Treasury Secretary Bessent promised back in February. So where are the economy and asset markets headed? Early evidence suggests paradigm C, which features all the fiscal and monetary largesse of paradigm A, plus a collection of supply-side sweeteners that are all favorable for Wall Street. Paradigm C represents a much bigger risk for the bond market than it is for the stock market and other risk assets. While the U-shaped economy is still ahead of us, bears would be remiss to assume that risk assets can't look through a transitory slowdown in growth and continue their V-shaped recovery. That is the modal outcome if, in fact, paradigm C is the ultimate destination. While it is too early to definitively conclude paradigm C is the destination, it is safe to assume the increased probability of paradigm C is why both Kiss and Dr. Mo have gotten increasingly invested in recent weeks. Per our April 10th leadoff morning note, the distribution of probable economic outcomes is as wide as most investors have ever seen, so remain dispassionate and ready to pivot if and when Kiss and Dr. Mo pivot. Odds are you'll thank them later, even if you or we do not trust or fully understand why in the moment. The market is smarter than we are, and someone always knows something. In terms of our KISS portfolio construction, no pivots. KISS is currently at 50% cash, 15% stocks, 30% gold, and 5% Bitcoin. In terms of our 42 macro risk management process, the number one thing we do for our clients is to help you identify and position for the market regime. We do that with our global macro risk matrix. We talked about we get a little bit of a deep dive on the global macro risk matrix in yesterday's macro minute. So if you missed that, definitely check that out. And then we filter those signals through KISS and Dr. Mo, KISS being for retail investors and for Dr. Mo for institutional investors. And then everything we say, like W-shaped market and a U-shaped economy, or V-shaped market and a U-shaped economy, or anything we talk about with respect to liquidity, positioning, inflation, the Fed, yada, 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 all that's just designed to help you understand what the full distribution of probable economic outcomes is shaped like, where it is in market pricing terms. And ultimately, it's designed to just create a general understanding of what might happen in the future, so that when our systematic overlays like KISS and Dr. Mo start to tell you to do something different in your portfolio, you feel confident enough to just dispassionately execute the signal, as opposed to what a lot of investors do, which is fight the signal because they have some core fundamental belief that they are, wedded to and are being dogmatic about. We're the opposite of dogmatic. This process keeps you honest as an investor, and it keeps you on the right side of market risk. Is it going to buy the bottom or sell the exact top? No. But is it going to sell right after the top or buy right after the bottom? Yes, that's exactly what it's going to do. And that's how we help our clients maximize upside capture, in the long term bull runs. Like I said, we're never going to be the people in the market buying on April 4th. That's just not what our process is set up to do. But we will be the people in the market, selling on March 3rd and March 5th. And or Bitcoin terms back in late February, and then buying, in mid to late April. That's what our process is designed to do. We want to take out the most of the drawdown from your portfolio, put that in cash, avoid most of the drawdown, and capture most of the uptrend. We're never going to capture 100% of the uptrend. We're never going to sell the exact top and buy the exact bottom, which means we'll avoid 100% of the downtrend. But if we can avoid, let's say, 80% of the downtrend and capture 80% of the uptrend, that's phenomenal result. And that's and more importantly, if you can consistently repeat that process over and over again across multiple market cycles over the course of your investing journey, you're going to wind up very rich, and you're going to wind up retiring on time and comfortably. So you just have to have the confidence to continually execute a high quality, institutional grade, dispassionate process, risk management process dispassionately. And if you can do that, you will retire on time and comfortably. I guarantee it. We use our global macro risk matrix to now cast the market regime, which investors must position for to avoid FOMO or FOMO. Fear of missing out causes investors to buy cycle tops, and fear of more losses causes investors to sell cycle lows. In terms of our deflation remains the market regime has the highest sum and share of confirming markets. The strength of signal, which is the total amount of signal being generated by the model at any given time, which is again only features the bullish and bearish signals across these 42 very important macro markets. There's right now we're only in the 23rd percentile of daily data going back to January of 1998, and as you can see here in this chart, the dispersion between the four regimes has really narrowed in recent weeks. And so whenever you have a low strength of signal and a low amount of dispersion between the regimes, that tells you that markets are seeing a increasingly flat distribution of probable economic outcomes. And that is always what happens when you're on the precipice of regime change. Now, we may not be on the precipice of regime change, but every time you are on the precipice of regime change, that is what occurs. The strength of signal starts to go down, the dispersion between the four regimes starts to go down, and ultimately a new regime emerges, triumphant. And so, I don't want to speculate yet as to what regime we're headed into potentially, but I do want to call out the fact that it appears that we may be on the precipice of market regime change, and for all the reasons why. And if we're heading into a risk-on market regime, which would be Goldilocks, risk-on with the disinflationary bias, or reflation, which is risk-on with an inflationary bias, if that's where we're ultimately headed, that, in my opinion, is a function of paradigm C, as we talked about in the executive summary, and we'll provide more color on as we conclude the presentation today. Let's keep moving here. In terms of investors should use our discretionary risk management overlay, aka Dr. Mo, as a market timing and position sizing guide for factor long short bets. So in terms of where we are with Dr. Mo, so you go back a few weeks ago, Dr. Mo was pretty bearish on equity and credit risk, less so on like crypto and gold and silver miners, but on equity and credit risk, it was pretty bearish. Just kind of checking in with Dr. Mo today. It's got a long half position in U.S. equities, U.S. equity beta, comm services, consumer discretionary, consumer staples, information technology, real estate, and utilities. So, and then that's on the sector side. And on the factor side, it's got a long cap position growth, large caps, low beta, mega cap growth, momentum, and quality. So that's a big change from where we were, let's say, 3 or 4 weeks ago. Not all of this is, occurred last week. There were some things that were starting to break out, 2 or 3 weeks ago. And then over the last 2 or 3 weeks, we've gotten more and more positive pivots from a Dr. Mo perspective in the equity sector and equity factor from the perspective of U.S. equity sectors and U.S. equity factors. So that was noteworthy. Another thing we talked about over the last couple of weeks is the fact that all the international VAM signals were better than the U.S. VAM signals, broadly speaking. That's no longer the case, but that had been the case, and perhaps that was a leading indicator that this pivot towards paradigm C and away from paradigm B. 2-year nominal treasury and 2-year nominal treasury yield are both still bearish. They're now yields are starting to spike. I think the underlying resiliency of the U.S. economy that we have been espousing. I think we were pretty early into calling, hey, I don't think we're going to go into recession. I think if we're heading to paradigm C, then what's going to happen is the consensus recession probability to go down. You'll start to see all these Wall Street firms, follow us. We're not even follow us. Come back towards us in terms of pulling back their recession forecasts, and ultimately that paradigm C is a better economic outcome than paradigm B. And so I think that's what markets are probably reflecting. In my opinion, bonds don't reflect that, at least not yet. Not at 431 on the 10-year, not at 382 on the 2-year. I think you could probably see 50 to 75 basis points of increase. I don't see why we don't go to 5% of the 10-year at paradigm C is the ultimate destination. 2 years, a little bit different. But there's just definitely still upside risk in nominal yields and real yields across the curve if paradigm C is the outcome. So I would be more concerned about the bond market than I would be about the stock market and other risk assets if, in fact, paradigm C is becomes the modal outcome. You're talking about real GDP growth, or ex government and ex net exports, accelerating to 6.2% in Q1, and year over year accelerating to 3.9% year over year in Q1. So fastest rates we've seen in this in years. So that it tells you that there's a real underlying resiliency in the economy, and we also see underlying resiliency in the economy as evidenced by real final sales to private domestic purchasers. We got a modest acceleration to 3% on a quarter-over-quarter SAR basis, essentially flat at 3% on a year-over-year basis as well. This is the 9th consecutive quarter of roughly 3% or more private real final sales growth. So this is an economy that's been resilient, and it remains resilient. And again, the resiliency of the private sector in this economy comes from the fact that we continue to pump $2.5-ish trillion year after year after year into the economy from the perspective of the budget deficit. And the budget deficit has grown substantially in the last couple of years. And so, we may see a little bit of retrenchment in that regard, but we may not. I mean, again, they're trying to pump $5 to $7 trillion of tax cuts onto the public sector balance sheet. So, But deficit is, according to our math, according to the Committee for Responsible Federal Budget, the Senate's current budget resolution, if it survives as is throughout the reconciliation process, is about 160 basis points per annum in terms of deficits, incremental deficits over the next 10 years. So right now we're at a deficit to GDP ratio of 7%. If you add that to it, it would be 8.6%. So we just have a structural budget deficit of almost 9% in this economy, in a fully employed, no war, no recession economy, right? I mean, this is nuts. This stuff is nuts. And I never thought I'd live to see the day where the Republicans were the problem as it relates to blowing up the U.S. Public sector balance sheet. But here we are. So I guess I've lived long enough. That's how you know you're old. Keep moving here. The U.S. labor market remains resilient, as indicated by persistent above trend growth. And so if you look at, we got the jobs report on Friday. We had a private sector employment growth slow to 0.8%. That's below trend on a 3-month annualized basis. We use the mean in the household and establishment surveys to calculate that. Private sector average hourly earnings also decelerated to 3.4%. That's slightly above trend. And we had a significant acceleration in private sector weekly hours that's accelerated to 2.4% on a 3-month annualized basis. So when you productize these features, you wind up with our private sector labor income metric, which slowed modestly to 6.6% on a 3-month annualized basis. That number is well above trend. It actually accelerated on a year-over-year basis to 5.8%. That number is also well above trend as well. So we have this persistent above trend income growth. Now it's probably going to slow. Obviously, we smooth Hawley tariffed ourselves. But again, you have to understand what the base rate is. And if you want to make a forecast, so many people spend most of their time when they talk about the bad forecasters spend all of their time talking about the future. The good forecasters spend half of their time understanding exactly what the base rate is so that they can make modest and calculated adjustments to the base rate when they forecast. The bad forecasters are always, well, I think this is going to happen. And I have no clue what's happening behind me. I have no clue where my feet are, but I'm going to tell you with 100% certainty that this is going to happen. And I see that kind of stuff on Twitter all the time. And that it's when you're an institutional investor and you spend most of your time communicating and interacting with institutional investors, as I do, throughout the week, it's so easy to spot the snake oil and the charlatan, cocksure, high confidence, this is going to happen in the future type research that would, quite frankly, get you laughed out of a room on Global Wall Street. And so that's why those people sell research to retail investors, because retail investors, by and large, are gullible enough to consume that nonsense. We elevate what retail investors consume, and we're trying to change the game in terms of how you guys think about, contextualizing economic risk and ultimately positioning for that in your portfolio. And obviously through the use of our systematic signals, which I think are much better than what most people are doing from a fundamental standpoint, which is, I think, therefore. I'll tell you right now, the dimensionality of probable economic outcomes is too large to do, I think, therefore, in the middle of a fourth turning poly crisis. It just is. I think you'd have to have a tremendous amount of hubris as an investor to think that you can think, therefore, all the way through a fourth turning poly crisis. I think the Trump administration just found out how hard this stuff is throughout the month of April. So, and that's why they've been backtracking and moving us towards paradigm C in our view. Consumers on the top part of the K still have plenty of money to spend, which is why services consumption remains robust. So we saw a acceleration in the month of March in real personal consumption expenditures to a below trend rate of 1.7%. It actually accelerated on a year-over-year basis to 3.3%. The acceleration was driven by an acceleration in real services consumption, which is 2/3 of consumer spending. Real services consumption accelerated to 2.3%. That number is 2.3%. That number is slightly above trend. It accelerated on a year-over-year basis to 2.8% as well. We also had a meaningful acceleration to an above trend 4.1% on a real disposable personal income basis. So income continues to grow robustly as well. It's actually growing 7.6% on a nominal basis, well above trend as well, and also accelerating. And so we have income moving in the right direction to support consumption, at least through March. And then we have the savings rate tick back down to 3.9%. In my opinion, that's very clear evidence of the West Village Montauk effect. If you give, if consumers feel okay, they will take the savings rate down because they don't need to save as much based on the amount of the stock of savings on the household sector balance sheet that we talked about again in yesterday's macro scouting report, which was, phenomenal if I do say so myself, but obviously I'm incredibly biased. So let's keep moving. Rich people continuing to consume services at above trend rates will support income growth and employment growth for consumers on the bottom part of the K. So again, paradigm C is basically the top-heavy K-shaped U.S. economy on steroids, basically. That's what I'm trying to argue. That's what I'm essentially saying. You're doing even more fiscal large S. You may not have even more monetary large S, but maybe eventually we do. Who knows? But I think it'll be smart policy for powell to stay put here. You don't want to lose the dollar and lose the bond market by easing preemptively, but that's neither here nor there. But getting into why rich people feeling confident enough to continue consuming services at an above trend growth rate, how that trickles down to the consumers at the bottom part of the case, because the U.S. is a services-oriented economy. Services is 90% of GDP and 86% of total employment, right? So if you want to get the U.S. business cycle right, you need to focus on the services economy. And as long as the services economy is doing okay, the U.S. economy will do reasonably okay. So that may be also what other markets picking up on as well this week. Instead of paradigm B, markets will have likely begun pricing in a new let me say it again. Instead of paradigm B, markets have likely begun pricing in a new destination. Paradigm C, which features all the fiscal large S of paradigm A. So let's talk about the fiscal large S. Right now, the U.S., if you look at annualized calendar year to date totals for federal revenue, we're 4.7 trillion. We're at 7.0 trillion for expenditures, for a budget deficit of 2.4 trillion. So we have an annualized calendar budget deficit of 2.4 trillion. If you annualize it on a fiscal year to date basis, it's right around 2.4 trillion as well. So again, a budget deficit that is widening on a calendar year to date on an annualized basis, a 350 billion. The budget deficit is $351 billion larger this year than it was last year on an annualized basis. It was $250 billion larger in 2024 than it was in 2023. And then it was $365 billion larger in 2023 than it was in 2024. I mean, that's like an extra $1 trillion. This is nuts. This stuff is nuts. I mean, I don't know what to say. I mean, other than you should not expect really negative outcomes if this is the kind of fiscal policy we're stuck with. And this is something we've been arguing very clearly and cogently in our investing due to foreturning regime analysis for years now. And obviously it's found its way into the main part of the macro scouting report presentations. But the growth rate of these politically protected categories, like if you look at our friend Luke Groman's true interest expense, that's Medicare, Social Security, National Defense, and net interest. So obviously Medicare and Social Security are politically protected. National Defense is not only politically protected, they're going to add another few $100 billion to that. And then we obviously net interest, they can't control that. And so that category of spending has been compounding, which is, by the way, it's $4.3 trillion on an annualized basis. It's 61% of the federal expenditures, 15% of nominal GDP, and it's been compounding on a trailing 3-year CAGR basis at plus 10%. Double-digit growth in the things that we know are definitely not going to ever go down until we run out of money. Double-digit compound growth. If you want to add Medicaid in that, because Medicaid has very clearly become a politically protected category, if you look at the Senate, nobody in the Senate wants to touch Medicaid because they understand that a lot of the senators are in states where there's a lot of their constituents, on Medicaid. And so that's become a politically protected category as well. President Trump has signaled he doesn't want to reduce Medicaid benefits for American citizens. So if you add Medicaid into this category, it's $5 trillion. It's 70% of the budget of the expenditures. It's 17% of GDP, and it's been compounding on a trailing 3-year CAGR basis, up plus 9%, so almost double-digit growth. So if 70% of the budget is off limits from cutting making material cuts to, and quite frankly, continuing to grow, if you look at net interest in national defense growing likely to grow about $100 billion each this year. Those categories are 70% of the budget, and they're compounding growth at 9%. So if you wanted to just keep the budget deficit flat, if you want to keep the budget deficit flat without, I'm not talking about reducing the budget deficit, just to keep it flat, because you have this 9% compound growth in these politically protected categories, you would need the other 30% of the budget to be compounding down 20%. So are they going to cut the other 30% of the federal budget by 20% persistently year after year after year to keep up with the 9% type growth of all these politically protected categories? No, the answer is obviously not. So we're already right now, we're at a 7% budget deficit to GDP. I mean, we did the scenario analysis with Doge in the macro scouting report yesterday. If you assume Doge cut $1 trillion, which I don't think they're on the path for anymore, that Elon would be going back to Tesla if they were, serious about this. If you cut $1 trillion out of the February high from federal expenditures and flow that all the way down straight to the bottom line with no impact on revenues or the economy, and then just see what the budget deficit would be there, it's still 6%. So let's assume it's 6%, and then they layer on trillions more dollars of debt finance tax cuts on this deficit. And you talk about these growth dynamics that I just highlighted. I just don't see how. I mean, we could have like a sustained 8, 9, maybe even 10% budget deficit, by the end of this administration. So just be aware of that. They're talking tough on on fiscal retrenchment, but the actions speak louder than the words when you actually crunch the numbers. And so I want the world to understand that. Paradigm C, actually, no, I don't want the world to understand that. I want you guys to understand that so you can benefit from it. Paradigm C also features the monetary large S of Paradigm A. We talked about this yesterday in the macro report, but the Fed never, one of the clearest indications of us that Jay wanted a soft landing when we introduced the theme back in the beginning of November 2023, we said, hey, they're going to stop hiking interest rates here. They didn't even get they didn't even create a positive spread between the Fed funds rate and the baseline Taylor rule, which we would interpret as, okay, policy is restrictive. You have a higher Fed funds rate than the economy would suggest you should have. And they never even gotten there. They got close to a neutral policy rate, but now we're moving back in the other direction right now. And so right now the Fed funds rate is 100 and let's call it 5 rate hikes lower, the 5 rate cuts lower than it should be, or 127 basis points lower than it should be according to the Taylor rule. And they never got to a positive value. If you go back in history, you've had to achieve a positive value every single time to defeat inflation. And so they clearly, it was a very clear signal to us back then that the economy the Fed has an asymmetrically dovish reaction function. They are more concerned about the growth than they are concerned about inflation. They're concerned about both, but one matters more to them, as evidenced by this policy. And we've seen this, obviously it's hit the tape in the quarters since then. So, and now they're guiding right now. They're still guiding the rate cuts, by the way. I think the dot plot is at 50 basis points of cuts this year. The markets expect 122 basis points of cuts over the next year. That seems aggressive in our opinion. But the key takeaway is that Jay Powell Fed has been incredibly dovish the whole time. We wouldn't have the 40-year high inflation if not. And he continues to be dovish from the perspective of, this kind of spread between the Fed funds rate and the Taylor rule. So, they're talking tough, and in my opinion, they're doing the right thing by not rushing to cut interest rates, because I think if you rush to cut interest rates right now, what will ultimately happen is you're going to lose the long end of the treasury curve, and the dollar will start to go down. Those will be kind of two sides of the same coin, dollar going down, cross-currency basis for the bond market gets worse and worse and worse. The bond market goes down because inflation expectations are going down, and it becomes a reflexive cycle. And this is the kind of stuff you see in emerging markets, folks. So I think Chair Powell is doing exactly what he should be doing, in our opinion, which is absolutely nothing. And if you do anything, it should be to talk up the dollar, and because that will keep the bond yields anchored. I don't think the Trump administration understands that, because they continue to apply pressure on Powell to cut rates. So that's neither here nor there. But at the end of the day, ultimately, Paradigm C is a greater risk to bonds than it is to stocks and other risk assets. If we're talking about basically copy and pasting the fiscal and monetary large S from Paradigm A, and then layering on, $5+ trillion of tax cuts, not being serious with the amount of spending cuts that they're going to recommend, right? We continue to think that right now the Senate and House, they had a handshake agreement on 1.5 trillion in spending cuts, which again is 150 billion per year. It's not a full 100.5 trillion like Doge. Doge would be a whole trillion out of this year's spending, which is $7 trillion. When the House, we're talking about these, 5 trillion for tax cuts, 1.5 trillion for spending cuts, you got to slice that in tenths because we're talking about a 10-year budget window. So, they're trying to legislate at maximum, in our opinion, $150 billion of spending reductions for this year. And it's a comically small, it's a raindrop in the ocean relative to the size of the federal expenditures. And so that's what I keep saying. Like, it's no secret, it's no surprise to me that term premium continue to widen in the bond market. We're at 56 basis points now. We're roughly roughly 100 basis points below the long run mean. If you subtract the deviation from the long run mean from the interest rate, you're talking about a fair value from the 10-year nominal treasury at 5.22% as of 4.31%. And I think we're going to a normal level of term premium. Now, the risk, in my opinion, which could ultimately become a risk for broader asset markets, if we go beyond normal level of term premium. And I would argue an economy that is a twin deficit economy that is currently at a 7% budget deficit and a 4% current account deficit that goes to let's call it 8 to 9% non-war, non-recession budget deficit, and potentially like a 5% current account deficit. Term premium got to go way higher to account for that. So eventually, Paradigm C will become bearish. But right now, from this starting point, if that's where we're heading, Paradigm C is actually quite bullish. So just be aware of that. Again, I don't know enough. I don't think anybody knows enough. I don't think anybody. I don't even think the administration knows exactly where we're headed, because ultimately a lot of this is going to come down to how President Trump feels about his approval ratings, how he feels about being taken advantage of in negotiations, and ultimately his ability to regulate his emotions in response to what may be some very aggressive demands from the other side of the negotiating table. Right, the Japanese finance minister was asked on Bloomberg. What was he asked? You guys are the biggest foreign single country holder of U.S. Treasuries. Are you prepared to use that as a chip in the negotiations? And the Japanese finance minister, so Scott Bessent, the Treasury Secretary, his counterpart in Japan, said, "quote," or not quote, I'm paraphrasing, but he said, "Yes, that is a chip we could use in negotiations. Whether or not we use it is up to the Trump administration." Right. And so I've been preparing you guys for this for weeks and weeks and weeks, ever since April 9th. Well, we've been preparing for all this since summer of 2023, when we started talking about this fourth turning poly crisis with our data-driven empirical analysis, which, by the way, coming to the dashboard soon is a fourth turning section where you can go review our historical fourth turning presentations, as well as our fourth turning FAQ that we just finished. So that'll be fun for you guys, for those who are new and want to get more deep dive on this fourth turning poly crisis. But to me, the fact that, if the other countries, which they should, by the way, they're creditor economies, capital accounts sacrosanct, it's more important than the current account, in my opinion. They should, like I said a few weeks ago, come into these negotiations and put their feet on the table and tell Trump to back off. And if Trump takes that poorly and has an inability to regulate his emotions in that moment, then all bets could be off in terms of Paradigm C. He could just try to rip up the script and go to Paradigm B again and say, screw it. I'm going to bully my way into Paradigm B. So this is, there's a lot of, human analysis right now in terms of trying to figure out which paradigm we're entering and exiting. We know we're exiting Paradigm A. It's either going to be Paradigm C or Paradigm B. I think it's going to be Paradigm C. That seems to me as the highest probability outcome, as evidenced by the recent movement in markets across our market signaling process. But there's no guarantee. And so I still think there's upside risk if that becomes true, because it's not 100% probability according to the average market participant. I'd say Paradigm C is probably a 40 to 50% probability right now. So if that probability goes to 100 in the coming months and quarters, then you're talking about a sustained bull run from here that doesn't necessarily have to have a significant amount of monetary stimulus to support that. So just want to open your minds to that possibility today. But at the end of the day, what you should be doing is continuing to dispassionately execute KISS and Dr. Mo. You should respect the fact that not every trade you make in KISS or Dr. Mo is going to make money, or not every trade in KISS and Dr. Mo is going to be perfectly nail it. It's not. I'm telling you right now. So if you're expecting perfection from 42 macro in terms of our signals, it's a ridiculous expectation. But if you want to maintain that ridiculous expectation, I want to tell you now, you're wasting money. If you want to drink Kool-Aid from snake oil salesmen and charlatans and shills that are constantly going to tell you exactly what you want to hear with 100% conviction and 100% certainty, so that you can do things that get them paid, not yourselves, that's totally fine. If you want to be shilled, go get shilled. But if you want to retire on time and comfortably, this is the place to be. If you want to make sure that you maintain your buy-side seat and continue to collect fat bonuses, this is the place to be. So make it I'm draw a line here. 42 macro, retire on time and comfortably, earn fat bonuses on the buy side. Outside our paywall, get shilled to near death. If that's what you guys want, be my guest. Things are good over here, though. So we'll catch you back here next Saturday. Cheers.